Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
All right, picture this, right? You're in your cushy corporate finance gig, surrounded by, spreadsheets and projections.
Yeah.
Got the whole world of these established companies figured out, right? Steady growth, predictable profits,
Yeah.
the whole 9 yards.
Right.
But then somebody throws you a curveball. They're like, okay, now go figure out startup finance.
Oh, yeah.
Talk about a head spinner, right?
It's definitely a completely different world, that's for sure.
Totally.
In the startup world, you see, profits aren't necessarily the main thing, at least not at the beginning.
Right.
It's all about growing super fast.
Yeah.
Even if it means, spending a lot and waiting longer to see a profit. Like, think about Amazon.
Yeah.
They were losing money for almost 10 years.
Wow.
They wanted to be the biggest, not the most profitable, at least not right away.
That's fascinating.
It really changes how you think about finance,
Yeah. Kind of throws the old rule book out the window, huh?
Totally. Makes you think, how do these startups even stay afloat while they're burning through all that cash?
Right. What kind of magic are they using?
Well, that's exactly what we're going to unpack in this deep dive.
Love it.
You and me, we're going to dig into the unique ways startups get the money they need to grow so fast, the key numbers they watch like hawks,
Uh-huh.
and of course, all those crazy success stories and the ones that didn't go so well to show you just how risky but exciting this world can be.
So let's get down to brass tacks. What's the biggest difference between startup finance and the corporate finance world? What makes it so different?
At the heart of it, it's all about the goals, man.
Okay.
Established companies like Apple or Microsoft, they're obsessed with efficiency and having a steady stream of cash coming in.
Right.
They're all about getting the most out of what they're already doing, squeezing out every penny of profit, and just keeping things nice and steady for their investors.
Like a well-oiled machine.
Exactly. Humming along, smooth and predictable.
But startups, they're a different animal.
Oh, absolutely.
They don't want that slow, steady growth. They want to, shoot for the moon.
They're driven, man. Like relentless ambition to shake things up and grab as much of the market as they can as fast as they can.
So it's like a land grab.
It is. It's like they'll spend, even lose money just to make sure they get there first.
So it's all about speed and agility over short-term profits.
You got it.
High risk, high reward. But how do they actually pay for this crazy growth?
I mean, they're not printing money in the basement, right?
Right.
Of course not.
Okay, good. Just checking.
There are a few main ways startups get the money they need, and each one's kind of unique.
Okay.
Venture capital and private equity, those are the big ones.
Okay.
They give you a ton of cash, but they want a piece of your company in return.
Makes sense.
Think about Airbnb.
Yeah.
They got a bunch of money from Sequoia Capital, and boom, huge IPO.
That's a pretty familiar story, right? The startup makes it big with VC money.
Yeah. But there's this other thing, bootstrapping.
Right, bootstrapping, like Airbnb and even Stripe, the payment platform.
Yeah.
I've heard they started that way. What exactly is bootstrapping, though?
Bootstrapping means you use your own money, your savings, maybe some early customers' cash, even side hustles, just to keep the lights on.
Wow.
It's scrappy,
Super scrappy.
You gotta be super resourceful and build something people really, really love.
It's like the David and Goliath story, right? The underdog fighting their way to the top.
Yeah.
So when does a startup need to go out and look for that outside money?
Right.
And how do they choose between venture capital and bootstrapping?
That's where things get really interesting.
I bet.
It depends on a lot of things,
Yeah.
actually. The industry they're in, how fast they're growing,
Yeah.
and how much risk the founders are comfortable with. Some startups, like Shopify and MailChimp, they built billion-dollar businesses without taking a ton of money from investors. They focused on building a really strong foundation, making money early on, and putting that money right back into the business.
That's pretty amazing.
But, getting funding isn't a walk in the park.
I can imagine.
It's tough. Lots of startups get rejected.
Right.
Investors want to see a great team, a really innovative idea, and a clear path to making money. And even if you do get the money,
Yeah.
you got to be super careful with it.
Mm.
WeWork is a good example of what not to do.
Oh, yeah.
They had billions from SoftBank,
Yeah.
but they spent recklessly. Their valuation was way too high, and the whole thing just imploded.
Wow. Talk about a cautionary tale.
It shows you there's a thin line between growing aggressively and just being reckless.
Yeah. So how do startups plan for this super fast growth they want? What numbers are they watching?
One of the big ones is burn rate. It tells you how much cash they're using every month.
Okay, so like a fuel gauge for their business.
Exactly. It
Yeah.
shows how quickly they're using up their resources.
Yeah, makes sense.
And that's where runway comes in.
Runway.
Yeah, it's basically how much time they have left before they run out of money.
Oh, wow.
It's like if a startup burns $50,000 a month
Yeah.
and they've got $500,000 in the bank,
Yeah.
their runway is 10 months.
So it's like a countdown clock until they either start making a profit or find more money?
Exactly. Investors watch these numbers super closely. They want to see that a startup is smart with its money and has a plan to, eventually make a profit.
Of course.
But it's not just about watching the clock. Startups also need to know if their growth strategies are actually working right.
Right.
There's this other important metric, especially for software companies. It's called CACLTV.
CACLTV.
It's the cost of getting a new customer versus how much that customer will spend over their lifetime.
Gotcha. So it's got to be worth it to get that customer, right?
Exactly. You want to make sure each customer brings in more money than it costs to get them.
So it's not just about getting any customer, it's about getting the right customers.
Exactly. The ones who will stick around and spend money over time. It's definitely a balancing act.
Big time?
And it's one of the toughest things startups have to figure out. Finding a cheap way to reach the right people and build a loyal customer base, that's the key.
This is all starting to click now. But what about profit? Where does that fit into all this? It seems like growth is all that matters in the startup world.
You're right. It does seem that way sometimes.
Yeah.
And it goes back to what we were saying about Amazon before.
Right.
They lost money for years.
Yeah.
Early on, they cared more about how much revenue they were bringing in, not about turning a profit.
It's like they're playing a different game.
They are. It was a huge change from the way traditional companies thought.
So we've talked about the fuel, the metrics, but can we look at some real world examples of startups who either totally nailed it or,
Crashed and burned.
Yeah, exactly.
Let's do it. We'll dive into some case studies.
Awesome.
We'll look at the success stories, companies like Airbnb, Tesla, Shopify.
Yep.
And then the ones that, didn't fare so well.
Right.
Like Theranos, BlackBerry, and Kodak. Each story shows us something about the crazy dynamics of startup finance.
Okay, I'm ready to learn from the best and maybe not the best. Bring on the case studies.
All right, let's go.
Okay, so we've talked about all the crazy ways startups get funding, from the thrill of venture capital to the, the grit of bootstrapping. It's clear that these startups need fuel to launch their rocket ships. But what I'm really curious about is how do they actually, navigate that whole funding process? It's not just a one-time deal, right?
No, you're absolutely right. It's definitely not a one-and-done kind of thing.
Right.
It's more like a journey with different stages.
Okay.
And each stage means the startup's a little more, grown up.
Right.
And, of course, each stage comes with, its own set of challenges.
So is it kind of like climbing a mountain? Like each base camp is a milestone and they get a fresh injection of cash?
That's a great way to think about it.
Okay, cool.
Imagine the startup is like a team of climbers, right?
Okay.
They start with their first climb using their own stuff, maybe a little money from, friends and family.
Yeah.
This is like the seed round. It gets them moving, but they'll need more to keep going.
Right.
Then comes Series A funding. This helps them set up a better base camp, scale things up, and prove that their business idea actually works.
Okay.
Then you have Series B and C funding later on, which lets them tackle even tougher challenges, go into new markets, and just grow even faster.
I'm guessing with each round of funding, the company's valued even higher, right? Because they're showing progress, proving they're worth it.
You got it.
Yeah.
Each climb they conquer makes the whole expedition look more valuable.
Makes sense.
But it's not just about how much the company's worth. It's also about finding the right climbing partners, so to speak.
Right.
You want investors who get your vision.
Yeah.
People who've climbed this mountain before and can give you advice, not just money.
It's got to be super helpful to have those experienced partners, especially when things get tough or unexpected.
Oh, absolutely.
Yeah.
They can open doors for you, introduce you to the right people, help you avoid those common mistakes,
Right.
and even just, give you a pep talk when you're feeling discouraged. They've been there. They know the struggle.
I bet. But let's not forget about those climbers who go solo, The bootstrappers.
Yeah, the hardcore ones.
It might not be as fancy, but it shows real grit, real determination.
Totally. Bootstrapping forces you to be resourceful, to come up with creative solutions, and to really focus on your customers' needs.
It's like free soloing El Capitan. Super risky, but if you can pull it off.
Oh man, the reward is huge.
Uh,
So besides not having to answer to investors, what are the other perks of bootstrapping?
right?
Well, it often makes you more careful with your money.
Okay.
Since you're not relying on someone else's cash, every dollar you make goes straight back into the business.
Makes sense.
You're not as likely to, waste money
Yeah.
because you know how hard it was to earn it.
It's like learning to survive in the wild, You
Yes.
got to make the most of what you have.
Exactly. And sometimes that resourcefulness leads to really cool ideas and a much stronger business in the long run. Take MailChimp, for example.
Okay.
Built a billion-dollar email platform without taking any VC money.
Wow.
They focused on giving their customers real value, growing organically, and just sticking to their vision.
It's amazing that they pulled that off.
It is. It shows that there's no one right way to fund a startup.
Right.
Each one needs to pick the path that fits their goals, how much risk they can handle, and the challenges they're facing.
Okay, so each startup's got to find its own way.
Exactly. But no matter what path they choose, there's one thing that's always important: financial discipline.
Yeah.
Like, remember WeWork?
Yeah.
They had billions, but they didn't manage their money well, and it all fell apart.
It's like having a super fast car, but not knowing how to drive it, right?
You're going to crash.
Yeah. Which brings us to financial modeling. We talked about burn rate and runway a bit earlier.
Right.
But can you break down how startups use these things to, plan their finances?
So think of financial modeling as the map and compass for the startup journey.
Okay.
It helps them answer the big questions.
I'll say.
Like, when will we start making money?
Right.
How much more funding do we need to hit our next goal?
Yeah.
What if we hire 5 more engineers? What happens to our runway then?
It's like a choose-your-own-adventure book for finances, right?
Exactly. Different financial choices lead to different outcomes.
I like that.
With financial models, startups can try out different scenarios, see potential problems coming, and make smart decisions that give them the best chance of success.
Sounds like a pretty powerful tool, especially in the startup world where everything's so unpredictable.
It is. But remember, the model's only as good as the information you put into it. Startups need to be real about how much money they'll make, how much they'll spend, and what's happening in the market around them.
You can't just make up numbers and hope for the best.
Exactly.
But,
So we've covered funding, financial modeling,
yeah.
but there's this other idea I hear a lot: unit economics.
Right. Unit economics. What is that exactly, and why is it so important for startups?
Unit economics is all about understanding how profitable each little piece of your business is.
Okay.
Like, if your business was a tree, unit economics would be looking at the health of each individual leaf.
So zooming in on the smallest parts, how does that help you see the bigger picture?
It helps you understand the core of your business. It's about breaking down your costs and revenue really, really specifically to see if your business model is actually sustainable. Imagine you're running a subscription box service online, right?
Okay.
Your unit economics would be all about things like, how much does it cost to get a new subscriber?
Right.
How much money do you make from each subscriber on average?
Yeah.
And how much does it cost to actually pack and ship each box?
So it's kind of like dissecting a frog in biology class, but instead of a frog, it's your business model.
Yeah, that's a good way to put it.
A little gross, but I get it.
And just like a frog needs all its organs working right, a healthy business needs strong unit economics.
Makes sense.
If you're not making money on each individual unit, doesn't matter how many you sell, you're going to run into trouble eventually.
It's like building a house on a shaky foundation, right?
Exactly. It might look good for a while, but it won't last. Strong unit economics are the foundation of a business that can really make it.
Right. Got to have that solid base.
They let you grow your business knowing that every new customer, every unit you sell is actually making you money.
Okay, I'm seeing how unit economics is important.
Yeah.
But can you give me an example of a company that, either got it right or really messed it up?
Sure. Let's talk about Blue Apron.
Okay.
Remember them. They were that meal kit delivery service. Super popular a few years ago.
Oh, yeah. Blue Apron. I even tried a few of their boxes, actually. The food was good.
Yeah.
But I stopped subscribing. It was just getting a little pricey.
And that was their problem. Their
Yeah.
unit economics were just not working.
Really?
It cost them a lot to get new customers. The ingredients and packaging were expensive.
Yeah.
And a lot of people were canceling their subscriptions.
I see. So they were spending a bunch of money to get customers who weren't sticking around long enough to make it worth it.
It's like throwing a big party every week, but only a few people show up.
That's a good way to put it.
And eventually, the party had to end.
Right.
Blue Apron struggled to make a profit, and their stock, well, it tanked.
It's a good reminder that you got to really understand those unit economics and make sure your business model is sound from the ground up.
Absolutely. So we've talked about funding, financial modeling, unit economics,
Yeah,
feeling like a startup expert yet.
almost.
Well, before we wrap things up, let's look at some more real-world examples.
Okay.
Last time, we explored Airbnb, Tesla, Shopify, Theranos, BlackBerry, and Kodak. This time, let's dive into some new cases that really show the principles we've been discussing.
Sounds good to me. Let's see what we can learn from these startup success stories and maybe some not-so-success stories. We've been through a lot talking about startup finance. It's been quite a journey, you know?
Yeah, yes.
We've climbed those venture capital mountains, navigated those choppy bootstrapping waters.
Right.
We even, dissected the whole unit economics thing. It's been pretty wild.
It really has. And as we wrap up our deep dive, I hope you're feeling like you've got a better handle on how the startup world works.
Oh, for sure. But before we, celebrate reaching the summit, maybe we could recap some of the big takeaways for anyone who might have just joined us, you know?
Yeah, good idea.
What are the most important things you've learned from your experience in startup finance?
Well, the first thing is, you got to remember, startups play by different rules than big companies.
Okay.
Growth is everything to them, even if it means they don't make a profit right away.
Like those explorers setting sail, you know?
Exactly.
They were all about discovering new lands, even if it was dangerous.
And just like those explorers needed supplies and a good ship, startups need fuel to keep going.
Right, that's where funding comes in.
Exactly.
Venture capital can give them a big push, but it usually means giving up some control.
That's right. And if they want to do it on their own, there's always bootstrapping.
Yeah, the independent route.
But it can be a much longer, tougher journey.
For sure. But no matter how they get the money, they got to be smart with it. Right?
Oh, absolutely. Financial discipline is crucial. We've seen so many companies get tons of funding and just blow it all.
Like finding buried treasure and spending it all on a big party.
Yeah. You got to invest it wisely to build something that lasts.
Right. Makes sense. And that's why financial modeling is so important, isn't it?
It is. It helps them plan, anticipate problems, and make smart decisions about their money.
Like a map and compass for the financial journey.
Exactly. Helps them stay on course and avoid those financial pitfalls.
And then there's unit economics, like checking the vital signs of the business.
You got it. Understanding if each piece of the business is profitable.
Making sure the heart's beating strong.
Right. And one last thing, got to remember the startup world is always changing.
Yeah, things move fast.
Being able to adapt is key. Companies that don't change at the times, well, they go extinct.
Like the dinosaurs, right?
Exactly. So as you keep learning about startup finance, remember these key things. Prioritize growth, be smart about funding, stay disciplined with money, use financial models, understand your unit economics, and be ready to adapt.
That's a lot to remember, but it's all super valuable stuff. Whether you're investing in startups, advising them, or even starting your own, these principles will help you succeed.
I agree.
This has been such an eye-opening deep dive. I feel like I have a whole new understanding of how startups work.
Glad to hear it. And this is just the start of your journey. There's always more to learn and explore in this exciting world.
Well, on that note, we'll wrap up our deep dive into startup finance for today. Hope you enjoyed the ride.
Keep learning, keep exploring, and keep pushing the limits of what's possible in business.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.